Do you want to save hundreds of thousands of dollars in taxes while making a meaningful impact? Today, I'm talking with Tiffany House, a charitable tax and estate expert, about a little known but incredibly powerful strategy: integrating your charitable giving into your business exit. Imagine cutting $238,000 in taxes while turning that savings into $3.6 million for both you and the causes you care about. Sounds too good to be true? It's not. But most business owners aren't using these tools, but you should be. We're just scratching the surface in this interview. Listen in and learn how. Tiffany, welcome. I saw you speak last October in 2024, and my biggest takeaway from that, I think, of many, is the amount of savings that a business owner can have by thinking about their charitable giving in the same process of selling their business. And I don't remember the exact example, but maybe you can share it with us. But my recollection is they could save about $390,000 in taxes. And then by also giving to charity, they benefit more than if they hadn't given. And the charity, obviously benefits as well. And I think it was to the tune of $3.6 million. And if that doesn't get the attention of a business owner, I don't know what does. So I would love to start the conversation with how many business owners are actually considering this really amazing tool and tools in their exit process.
Well, that's a great question because it is a fabulous tool that can do a lot of great work in helping people save money, but also do good in the community. However, with this type of trust, you don't even have to be charitable to use it. I wish more people were using it. I can't tell you how many people are. I will say, being in Arizona, I feel a little bit like we're in the way out west. You see it a lot more frequently on the East Coast, West Coast, Midwest, and Texas, where they just do more advanced planning strategies. But there is a good education curve that we need to do to let business owners know that these are tools that they can use and they're not overly complicated, and it can really help them save a lot of money.
Yeah, no kidding. And I remember also seeing a list of maybe 27, maybe more different tools that they can use. And we won't go into all of those today, but maybe, I don't know if it's okay to share that list of tools that's out there. I can share that with the video as it goes out. But we're
Certainly.
going to dive into a few of them today.
Okay.
But first, I want to talk. You also mentioned about like how early planning is really important. And this is something that I am really on a mission to help business owners when they're selling to think super early, whether it's charitable giving, tax strategies, just in general, thinking early.
Mhm.
So just give a little insight of like why it's so important to think early, especially with charitable giving.
Yeah, well, it's important for charitable giving, but also there might be good options where they could give to family as well. So, really looking at, as a business owner, I think it's important to look 5 to 10 years out from the time of sale and say, okay, where am I going with my business? What's going to be going on? And making sure that your business structure is appropriate for what it is that you want to do for that future sale. So, I will say that I have worked with some people who were going to sell their business in 3 months, and we were successful and able to accomplish some good planning strategies. But if that's near the end of the year and the attorneys are busy that need to draft some of these documents, that could be really pushing it way too close. Also, it's nice to have an advisory team. Where I work, I'm a consultant. I do flat fee work, but it's the attorney who drafts the document, the financial advisor who will then help manage the money, and the CPA lets us know what tax issue that we're actually solving for. So I get to work with all of those other advisors. And it's important to know that you have the right team in place and
Mhm.
also have a good wide perspective of all the different tools and strategies that are available that might fit that client's particular needs.
Makes a lot of sense. And talk a little bit about, I love the solving for the right tax problem, right, from your CPA. And can you marry that with then the type of organization that they are, whether they're S Corp or LLC or what, how does that factor into their consideration as they think about charitable giving?
Yeah, well, S corporations are the most common type of corporation for closely held businesses. So we're looking at about 75% of businesses are S corporations. However, those have a little bit more limit on what tools we can use and strategies. So a charitable remainder trust and a pooled income fund cannot handle S corp stock.
Mm.
But a tool like a donor advised fund, and there's other strategies we can do to really help people save taxes. If you're a C corp, there's a little known fact out there that a C corporation, if you've been in business for over 5 years, and I believe in business since 1988 or after, come into business after that, there's a $10 million tax exclusion or 10 times your basis. So C corporation people need to look at that first. Do they
Mhm.
qualify for the 1202 qualified small business stock exclusion, where they could get that $10 million exclusion or 10 times their basis? Uh, so C corporations are also very easy to do a lot of other planning with, but we always look at that strategy first because it can make the biggest impact. LLCs are very easy to work with as well. Partnerships, it's going to depend on what is written in the partnership agreement. And that list of strategies you mentioned is actually a tools matrix that I put together on tax advantage business sales that goes through, is it an S Corp, C Corp, LLC, or asset? And then what strategies can you utilize? I did help someone who was selling a pallet business, and it was an S corporation, and we were not able to do any good strategic planning for the actual business sale. But what we did instead is we put the real estate into a charitable remainder trust. And we were then able to, like you said, solve for what the CPA says, because my goal is to never put too much into any one type of tool or strategy because it can have restrictions, which can also provide asset protection, which is nice.
Mhm.
But let's figure out what our tax problem is that we need to solve for, and only allocate as much of an asset into the tool as we need to also sell outside of the tool, so that we can have freedom and flexibility with those funds.
There's so many tools out there. I just want to say and make a case for having you or someone like you as an advisor as well. It's a lot to navigate. And if you're putting in the taxes in there too, it's you need a guide, it seems like to
Yeah.
me. Let's dive into the donor advised fund. I have found that that's not as well known as I thought it might be known. And it's frankly one of the tools that I am familiar with, which is why we're talking about it. Some of them I'm like, I don't even know what that is. And we'll let you dive into that with the people later. But talk about how a donor advised fund works for business owners that are looking to sell. And if you have any examples that you've helped companies through, that would be great.
Yeah. Well, a donor advised fund is your own personal charitable planning savings account, and it can grow tax free compounding. And if you put an asset into it, you get to sell it tax free. And a donor advised fund can accept S Corp stock. It
Okay.
does have to be drafted, though. The donor advised fund needs to be in the formation of a trust versus a corporation. So, not every donor advised fund could handle S Corporation stock. But a donor advised fund, I usually call my December planning tool because it's very easy to implement. It's something we can do at the end of the year. And yes, it's always best to put an appreciated asset inside of a tool and then sell it, because then we get to save on all the appreciation tax. And when you're selling a business, you often get into the situation of not necessarily knowing how much tax you're going to have to pay. And often your tax brackets will go up. So if you're in a high tax bracket, it's the year of the sale, that's 20% federal capital gains tax rate, and another 3.8% net investment income tax can hit you. And then depending on what state you're in, adding state taxes on top of there. So it can be anywhere to 20 to 40% in taxes that people are going to have to pay. So
Mhm.
it's very important to consider that. So with back to a donor advised fund, Like I said, they're very simplistic to initiate and to put together and to allocate those assets inside of it. But even if you've already sold your business and you're saying, oh no, I've got this big tax bill, as long as we were to make a contribution the same year as the tax issue, the donor advised fund could certainly be used to accomplish that as well. And you can put appreciated stock or some other type of asset in there as well.
Okay. Okay, that was actually going to be one of the questions. What are the assets that can go inside of that? But I think you just sort of alluded to that there. Can you give an
I
example?
will
Oh,
kind of to that
yeah.
point, it depends on the provider.
Okay.
So we have donor advised funds at community foundations. We where they can often handle complex assets. We have
Mm,
donor advised funds at financial institutions like Fidelity, Schwab, Raymond James. Those might have more limited ability of taking complex assets. And then there's other third party nonprofits out there that can actually take really complex assets and can help. And you can leave real estate in there and do some other things with those independent providers as well.
Can you walk us through an owner that has used a donor advised fund?
Yeah, so I was working with a gentleman and his wife, and he had owned about 40%, his father 60% of a insurance company, and a larger
Okay.
insurance institution was going to come in and buy them. The nice thing is people, another thing about business sales, people don't always look how the deal is structured.
Hmm.
So if it's structured as an asset sale, which this is, it can also qualify for ordinary income tax as well.
Okay.
But this sale was structured as personal goodwill, which is a capital gains tax asset for about 90% of the value. So we couldn't do a whole lot with actually planning around the sale, but he had been a young man who got himself into some issues, and he, fell a little bit into drugs and alcohol, and was very, very thankful for the life that he has. And so every time he would get any income, he would go ahead and give 10% of that away. So he
Hmm.
was writing checks to charities all the time, and his accountant was hating it because there's all those receipts to also manage. So what we
Hmm.
were able to do is we went ahead and created a donor advised fund, and we put in about as much as he wanted to pre-fund all of his philanthropy. We looked at what his income would be like moving forward, and so now he has the donor advised fund that has all of his philanthropy pre-funded in it. He gets a deduction the year of the sale of the business. And it really became a great win-win outcome. And who was most happy was his accountant, because now there was only one time that he was making a gift and only one receipt that he needed
Great.
to accomplish. So it worked out good for everyone.
That's awesome. That's a great example. That's great. I'm curious too, for myself and for others, when you're setting something up like this as a business owner, you can set that up well before you sell, right? I mean, and do this while it's going, and then talk about, and then like this is an asset in the sale, or this is an asset they're taking with them post sale.
So with that last example, that was just we ended up putting stock in there that he
Okay.
had sitting outside of the business. You
Mhm.
can use the business interest as well too. However, if it's an asset sale, you can't pull out certain assets and allocate them into a tool.
Mhm.
It's best if it's a stock sale where you can then utilize it. Or if you have planning ahead of time, you can separate out the different assets within the business if you think it's going to be an asset sale,
Okay.
and you can put them in separate entities so that then you can easily do some great planning at the time of sale.
Okay. All right. That sounds good.
Another
Um,
thing to plan
yeah.
ahead, right?
Yes, right. Exactly. Exactly. Kind of know where you're headed, which
Yes.
is good to do anyway, right? I want to circle back to the charitable remainder trust. That was the example I gave at the very beginning. And I know you have many others, but can you just walk through that in more detail, make sure my numbers are correct? And again, just how that all works. I know there were huge tax savings and just the amount that goes to the charity and the amount that goes to the business owner. It's just like a win-win and an amazing tool. So could you just talk a little bit more about that?
So what's really nice about a charitable remainder trust is you're able to put the portion of the asset that you want inside of the trust, and now you get to sell it tax-free. So just think, if we were just paying the 20% federal capital gains tax rate and the 3.8 net investment income tax, that right there would save you on $1 million. That's $238,000 that you now have working for you for your lifetime, making money. The other neat thing about a charitable remainder trust is everything grows inside the trust, tax-free compounding. So like how we like IRAs that are pre-tax dollars because we get our money working for us, same with, it's similar with a charitable remainder trust. What else is nice is it's called a remainder trust because the remainder is going to benefit charity. Often we set these up for a person's lifetime, two people's lifetime most often, but you can also add in a term of years if you want to, or just do a term of years for up to 20 years. So after whatever that is, if it's 2 lives plus a term, or if it's just 2 lives, the remainder is going to go to charity. And we get an income tax deduction today for that future gift to charity. That's why we often only put part of the asset inside a tool like this, because we're going to utilize that income tax deduction that we created to offset the taxes we have to pay on the portion of the sale that was outside of the charitable remainder trust. So now we've got 2 big, great tax savings. Another wonderful thing about it is this asset now is outside of your estate for estate tax purposes. Unless you do a term of years to include your kids, then it rolls back in. But now we're doing an estate tax planning as well. And then the people who set up, the donors who set up the charitable remainder trust get to get income for life. And when you take a look and compare the numbers of doing the trust or not doing the trust and the difference, you're right, it is significant. It's a huge number. Now, yes, charity gets some of it, but the family always comes out ahead as well. And the only issue that can really happen is if we did it for 2 people's lives, and then let's say they got hit by a bus in 5 years. Now they wouldn't have gotten the income out of it that they would have wanted. It was still a good planning strategy because we can't determine people's exact life expectancy.
Right.
So that's your biggest risk, is that people aren't going to live to life expectancy. I've also been working on doing some where we're doing it for a short term with some cryptocurrencies so that we can diversify crypto and do it in a tax advantage manner as well.
So speak a little bit more to that. So if you do it for a shorter term and it comes back to you, then what are the ramifications of that? What do they have to think about?
So the asset's not going to come back to you. It's always going to go to charity. The remainder is always going to benefit charity.
Got it.
But if you do it for a shorter term of years, you can take a lot of percentage or a lot of the amount, because there's a 10% remainder interest rule. That means that 10% of the future value of the remainder needs to benefit charity. So there is so that kind of dictates how much somebody can take out in income and how much will benefit charity. So there's another tool, though, called a pooled income fund that doesn't have that 10% remainder interest, which allows you to have up to 10 income beneficiaries. And you could even have an income beneficiary in that tool that's only 3 months old, as long as they have a social security number.
The pooled fund was on my list too to talk to you about. So perfect segue. Can you just go into that a little bit more, and then how you advise clients to use one or the other?
So a pooled income fund is actually very similar to a charitable remainder trust. Both of them allow you to sell the asset tax-free inside the tool and have all of that appreciation tax that you would have had paid to grow and work for you. With a charitable remainder trust, one caveat is the taxation of the original asset will follow the income, but you're going to be in lower tax brackets and you've had all that tax-free compounding growth in the midst. A pooled income fund, the taxation just drowns and you'll only ever be taxed on how it's invested. So both of them have a remainder beneficiary of charity. One thing to mention, though, that donor advised fund that we talked about earlier, that can be the charitable beneficiary of both of these tools.
Oh,
And we'll come back to that in a second because that's very valuable to create a living legacy for future generations.
okay.
And so they are both similar in that the remainder is going to benefit charity or their own family donor advised fund. They both provide income to the donor. The pooled income fund, it it depends on when it was created. If it's a new or they call it a baby pooled income fund, we're going to use the AFR rate, which is a rate that follows interest rates to determine what your initial deduction is. Because remember, in the charitable remainder trust, because we're going to give a gift to charity in the future, we get a tax deduction today for that future gift. Same with the pooled income fund. So a baby pooled income fund is going to look at the last 3 years of interest rates and determine what your deduction is.
Mm,
And if it's an old pooled income fund, it's just going to look at what the performance has been. So a pooled income fund, when you research them on the internet, you're going to get some old information because nobody's been working with them for a really long time because the charitable remainder trust provided a better deduction on the
mhm,
old pooled income funds. But now people are creating new pooled income funds each year. A family can even create their own pooled income fund
mm,
if they like. And a company called Eaton Vance, which a lot of people
mhm,
have heard of, I believe it's owned by Morgan Stanley, they have created a pooled income fund called the Legacy Income Trust.
mm.
And it's a pooled income fund that they create newly each year, and they have a dividend recapture strategy. They will only take cash or securities inside this pooled income fund. But if you created your own, you could have a lot more flexibility in the types of assets that you can donate, including business interest. Just no S corps in that one either.
Okay. And then can you give an example of, a client that was trying to figure out which one should I do and why they chose what they did, or why you advise them the way you did?
Yeah, well, kind of the big difference with it is if it's a really heavily taxed asset. So
Mhm.
I'm working with a family who works at NVIDIA,
Mm,
and they have some stock that has really appreciated and it's worth a lot now.
mhm,
So last year we went ahead and did a pooled income fund. Now, the three things to consider is if it's a heavily taxed asset, the pooled income fund might be better. If you want to include young beneficiaries, young income beneficiaries, the pooled income fund is better. And it depends on if interest rates are high or low. A
mm.
charitable remainder trust does best when the interest rates are high, and a pooled income fund does best when the interest rates are low. So we
Okay.
went ahead and did a pooled income fund in 2024 because we were able to get a higher deduction in 2024 because the rates had been lower. And
Mhm.
then now in 2025, we're going to use a charitable remainder trust to then diversify some more of the stock. We also included the children in as the income stream. So it'll go to the parents first, and then after the parents pass, their 5 and 15-year-old children will then get the income. So that's an example of really kind of utilizing both. I
Yeah.
also was helping an optometrist. He had venture capital investment that had come in and he had quite a bit of income. And we did this in the end of 2023 and we did that Eaton Vance pooled income fund and they were able to get over a 50% deduction.
Wow.
So it was
Wow.
very significant. And
Yeah.
I have to tell you, I thought like everybody else, pooled income funds are no longer, valid and nobody's
Mhm.
doing them because they were done at universities and hospitals or community foundations. And people really found that they could do better with a charitable remainder trust. But now that we can set them up for an individual family or utilize something like Eaton Vance, if the interest rates are low, it can be much better than a charitable remainder trust in terms of deductions.
Yeah, that's a question I have around that too. It's just more general. Is how often should you look? Is this like an annual thing? Do you look at your charitable giving biannual? Like, how often do you recommend that people look at updating their giving strategies, their trusts, etc.?
Yeah, well, I think that all of this needs to be part of a larger estate plan. That
Hmm.
we can have the best tool, we can have the best strategy out there. But if one, the client does not understand what they're doing or what they're getting into, it's not the right fit. And
Mhm.
even though it could look that way on paper, it really has to fit into their understanding and also their estate plan, their retirement plan,
Mhm.
their life plan about what's next and what's their next
Yeah.
act. So I recommend that estate plans be reviewed every 2 to 5 years, depending on how many things are changing in your life. And
Mhm.
these charitable planning tools can be included in there. And then
Yeah.
kind of an offshoot back to a donor advised fund, particularly being a beneficiary of one of these remainder interest gifts, is you can create a family legacy where you're going to bring generations in the future together to make grants in the name of your legacy by utilizing a donor advised fund like that. I personally, my husband and I have a donor advised fund. We call it the Giving Makes You Happy Fund.
Love
And
it.
because you can have anonymity too, which is a nice thing, right? Nobody has
Right.
to know where the funds are coming from.
Right.
And we have our children grant from it twice a year. They have to do research on the organization and they're supposed to volunteer. But
Okay.
another thing that I do with my clients, is particularly those with grandkids, is I have the grandparents create a donor advised fund now in life. And some of the planning strategies we do can then benefit that same donor advised fund at death. But then bring the grandkids in and have them do research and an oral presentation on the different charities that they want to support. Now, keep the parents out of it, keep that middle generation out of it. And now you're teaching those kids the values of giving.
Yeah.
You're teaching them how to do a presentation, how to prepare a report, depending on their age level and their skill
Yeah.
set.
Yeah.
They're having to present in front of their peers, their cousins and siblings. And now the grandparents are going to get to know those kids so much more because they're getting to understand what they're passionate about. So I love donor advised funds for that reason. So back to your question of when you should be looking at your philanthropy, I think a couple of times a year. And whether you're using a donor advised fund to do it, that's what my family does, is twice a year. But it's an important component. And one thing that gets overlooked is entrepreneurs are the most philanthropic class of people.
Yeah.
And I believe it's because
Statistically, right? I mean, that's like a
statistically,
yeah,
yeah, they
statistic
definitely they
back.
give
Yeah.
more, they give over double what non-entrepreneurs give, and they also volunteer more.
Mhm.
I believe that it's because they were probably mentored along the way and they see what it's like to give back.
Yeah.
So, having conversations with our clients or with people who are selling their business about some of these charitable planning tools, like I mentioned, if you live to life expectancy, it doesn't matter what goes to charity. You're going to end up ahead.
Mhm.
Or if you live longer, and happy people give, and giving makes you happy. So you have the opportunity to live even longer.
Yeah.
So I think it's really important to talk about some of these strategies, uh, regardless of people's charitable intent.
Definitely. I want to just go back a minute. I do the whole life planning and looking at the different areas of your life to make sure that in the what's next chapter, there's fulfillment and meaning. And many times the question is, how do we teach our kids about money, as the wealth transfer goes? How do we make sure that they understand the value of giving back? And I just absolutely love the example of doing the grant money, and they choose, they research, they choose, they pitch, right? They
Mhm.
make the case for it. I think that's amazing. I'm going to steal that as an
Yeah,
example.
please do. Yeah, no,
Yeah,
everybody should be doing it. I think it's
I agree.
a fabulous tool. So yes.
Yeah, that's amazing. I was going to go into charitable lead trusts, but honestly, I just picked that out from a list of many. Is there any? So what I'll do is just leave it open to you. If you want to talk about lead trust, that's great. Or if there's a charitable giving tool we haven't talked about to this point that you think is really crucial, or one that's used most often, I just open the floor to you on that.
Great question. I'm kind of thinking this through. One thing I'll say is private foundations have been very popular in the past.
Hmm.
And there was a lot of self dealing going on where people were putting assets in there that they were actually utilizing.
Mm.
So there was a big crackdown on private foundations. So now I use a donor advised fund instead of a private foundation the majority of the time. And one of the big reasons why is because if you give an asset, and my shoes, I say if you give cash, you're an amateur, because you can get so much more tax benefit if you give, even if you're just giving to your local food bank, give stock instead of cash. Pick your highest growth stock that has the lowest basis, gift that, and then whatever money you were going to give anyway, just buy the stock back. Now you have the same portfolio, and you just did step up basis work for that stock. So back to private foundations, you can only deduct basis on an asset when you give an asset to a private foundation. Now, with a donor advised fund, you can do 30% of your adjusted gross income, and it can be fair market value of your deduction. So I like using donor advised funds instead of private foundations. And over about the 5 million mark, we can use something called a supporting organization. And we can make it look like a private foundation. It has to support a nonprofit or a class of nonprofits. And you need board members from that class of nonprofits to be on your board, but it can provide a lot more of the flexibility that a private foundation used to.
Yeah.
Lead trusts are awesome. There's two different kinds. The non-grantor charitable lead trust is for estate taxes, and the grantor charitable lead trust is for income taxes. So it kind of depends on what issue you're having. I have used both of them with business owners when they were selling their business. The grantor lead trust is really kind of the after the fact. I already sold my business and I need a big deduction. So lead trust allows you to really have income go to charity, and then you or your family can get the asset back in the end. So lead trusts are neat. And there's something out there called a charitable stock of bailout, though it can be a little iffy on the code, but some people are out there utilizing that too. It just depends on what your business structure is and what your goals and your what you want to accomplish in your next act as to which tools we would choose.
Talk about just a little bit about, as we wrap up here, about the administration or the time involved in not just checking in on your strategy, but, if you're doing a donor advised fund or you do decide to do a supporting organization, which still is going to sounds like a lot of the structure of a foundation, even, so like talk about that piece of it. Like how much is it to manage this?
Yes, well, with tools like the charitable trust and a supporting organization or a foundation, you're going to have to file tax returns each year. So you're going to have to do that. You can pay an administrator to administer those trusts and then to pay those taxes. A donor advised fund, other than going in and making grants and adding more money if it's running low, really requires very minimal input from the donor, in that the supporting there's a donor advised fund is a fund inside a larger supporting charity. And that charity is the one who's going to file all the paperwork, make sure you're following all the rules, and do all of that due diligence. So it depends on the strategy, but donor advised funds are very easy and require very little work. Some of these others will require definitely tax returns and some upkeep, but you can always hire an administrator, and the tool can pay for the administrator. It can come straight out of that tool.
That's great. That's awesome. So what I'm hearing, business owners listening, it's not a lot of work necessarily, right? Like maybe a little initial upfront and then reaping a lot of rewards. Just speak a little bit, if you have clients that are post-exit and they've put these in place, and those that are using it, we talked earlier, like not everybody's using it for charitable reasons necessarily, more just a tax reason. But do you see people then get more involved in charities? Do you see their life not change necessarily, but be maybe enriched by setting something up like this?
Yes, definitely. So there's statistics out there that when somebody decides to leave a gift at death, that their giving to that organization more than doubles.
Oh,
So it definitely gets people, because think about it. When you make a commitment with an important part of your life and in your assets when you're no longer here, you want to make sure that organization is doing well. And you've already connected with them, you've chosen them. So it definitely increases giving. I had one family that I helped, they had a dermatology practice.
mhm.
And as we were going through the education, and the wife really got it, and the husband was the doctor, and he was the one I had to go back and redo the education with quite a few times, but
Yeah.
no problem. It was great. I want to make sure everybody fully understands this. We decided to do a charitable remainder trust for their partnership interests that they were going to be selling. However, in the process, I got to know them and know what's important to them, because like I said, one of these strategies needs to be incorporated in the entirety of their estate plan, life plan, financial plan. And there was literally something called shoegate with their oldest son. They had raised his child, their grandchild, until he was 7, and he was a runner. And he was a really good runner. He was going to go to college for running. Well, his dad didn't want to buy him shoes for some reason. I don't know why. And they're like, "Well, he needs to have new shoes. I mean, he's putting, I mean, he's like marathon
Yeah,
miles.
putting
You know,
miles
he's
on
putting,
those. Yeah.
yeah." So they bought him new shoes, and their son just blew up at them, and they didn't like him anyway. And he was an attorney. And they shared with me the story, and they said, "Yeah, we'd leave him out of our estate plan if we could, but we're afraid he's going to sue his two brothers when we die." So what we were able to do is we put together a charitable remainder trust that paid out income to them for their lifetimes, which actually they used to help their two favored sons buy homes. And then we added a term of 20 years for the two favored sons, so we could give a big, screw you to the the
Yeah.
old. It was not part of the going to be receiving the income from this
Yeah.
trust. But also, when we sat down, I asked them, "Are you charitable?" And they said, "No, we're not really." Well, when we sat down and actually listed out their beneficiaries of the charitable beneficiaries for their charitable remainder trust, there was over 15 of them on there.
Oh,
And then we included a donor advised fund as well. And I don't think they understood or really got that they really were charitable until we sat down and did that exercise.
mhm.
And they now give more to all those organizations. And it was really kind of a neat experience. And when I recommend for an attorney to draft one of these documents, however, I ask them to put the charitable beneficiaries on a separate schedule, so that if they want to change their mind in the future, they don't have to go and change anything with the trust. All they
Oh,
have to do is change that schedule, and
yeah.
then that can list out who receives the benefit, because it could be quite some time until those charities are going to receive those funds.
That's true. That's true. I actually love that just by calling out the giving they've done, they're like, oh, we are charitable.
Yeah.
We're going to own that identity now. Love that. That's
Yes,
really great.
yes.
That's really great. That's really cool. Okay, so you are obviously a huge wealth of information. We've covered, I feel like, this much of what we could have covered. How can people find you if they want to know more about charitable giving, tax planning around this, etc.?
Yeah, well, I'm on LinkedIn and all of the normal places.
Yeah.
Actually, I just hired a social media expert who's also my daughter. And she has been really good at getting me out on social media. I do travel the country for speaking engagements, so I'm
Okay.
busy and out there. So I give her lots of things to post about. So finding me on social media, my name is Tiffany House, and I have my Chartered Advisor in Philanthropy designation, which is a CAP. Also, I'm a certified exit planning advisor, which is the
Yeah.
SEPA designation. My website is tax and then the dash, or like the hyphen,
Hmm.
estate, estate.com. You can find me there as well. And I would love for you to share that tools matrix with everyone. And
Okay,
they can
great.
find more tools matrix on my website as well too. I have one for charitable trusts as well. And then I have one for wealth transfer. I haven't put on my website yet, but I should do that this week.
Okay, perfect. Your daughter will be proud. You just did a great job covering all of those. Tiffany, thank you so much for your time, sharing your knowledge, and just really helping people, making the case for being more charitable. It's a win-win.
Yes, it really is. And I really truly believe that when people give gifts to charity, it makes them happier people.
I think you're right. I kudos to that. Thank you.
Thank you.